Are you looking to make smarter investment decisions with minimal effort? Imagine having access to thousands of stocks across multiple sectors and even countries in just a few clicks. Today, we're diving into 4 powerful ETFs from BlackRock that can help you diversify your portfolio, manage risk, and capitalize on growth opportunities. From US stocks to global markets and even real estate, let's explore the benefits of these ETFs and how they can help you build wealth. Number 1. iShares Core S&P Total US Stock Market ETF, ticker ITOT. Let's start with one of the most comprehensive US stock market ETFs out there, the iShares Core S&P Total US Stock Market ETF, ticker symbol ITOT. This ETF is designed to give you access to nearly the entire US stock market, not just the largest companies in the S&P 500, but thousands of companies across all sizes and sectors. If you're someone who wants broad exposure to the US economy, ITOT is a no-brainer. ITOT has a low expense ratio of 0.03%, meaning that for every $1,000 you invest, you'll only pay 30 cents per year in fees. That's incredibly low, making this ETF one of the most cost-efficient ways to invest in the US stock market. Expense ratios matter because over time, high fees can eat into your returns, especially when compounded over years or decades of investing. Over the past 5 years, ITOT has performed admirably, delivering an annual return of 10.5%. While this is slightly lower than the S&P 500's average annual return of 11%, the difference is minimal, and the extra diversification you get by owning more companies may justify it for some investors. With a massive fund size of $42 billion, ITOT is one of the largest ETFs available, ensuring that it's highly liquid. Liquidity is crucial for investors because it ensures that you can buy and sell shares of the ETF quickly and easily without affecting the price. ITOT invests in over 3,600 companies, which is a significant advantage over S&P 500-only ETFs. That means your portfolio includes not only large-cap companies like Apple, Microsoft, and Amazon, but also mid-cap and small-cap companies, which can offer growth potential that large companies might not provide. The top 10 holdings of ITOT account for just over 23% of the total portfolio. At first glance, that might seem like a lot of concentration, but it's important to remember that this ETF, like most, is market cap weighted. That means larger companies take up a bigger portion of the fund. This weighting is typical for most index ETFs, and it reflects the size and influence of these companies in the broader market. Dividends are paid out quarterly, with a current dividend yield of 1.59%. While this isn't the highest yield out there, it adds a nice bonus on top of the capital appreciation you'll likely experience over the long term. Overall, ITOT offers a great blend of stability and growth by giving you access to a wide range of US companies in a single investment. Number 2. iShares Core MSCI Total International Stock ETF, ticker IXUS. Now, while ITOT provides excellent exposure to the US market, you might not want to put all your eggs in one basket. Historically, investors who focus solely on their home country's stock market have experienced significant risks. A downturn in one country can heavily affect your portfolio if you're not diversified internationally. That's where the iShares Core MSCI Total International Stock ETF, ticker symbol IXUS, comes in. IXUS gives you exposure to over 4,300 companies across 49 countries, excluding the US. This ETF is perfect for diversifying your portfolio internationally without having to worry about overlaps with US-focused ETFs like ITOT. By investing in IXUS, you're essentially hedging against the risk of a downturn in the US market while gaining access to opportunities in other regions. IXUS has an expense ratio of 0.07%, which is slightly higher than ITOT. However, this makes sense, given that international markets, especially in emerging economies like Egypt, Colombia, and Pakistan, are less efficient than developed markets like the US. Despite this, a 0.07% fee is still highly competitive for an ETF that provides such broad international exposure. Over the past 5 years, IXUS has had a lower annual return of 2.7%, significantly underperforming US-based ETFs like ITOT. In fact, IXUS recently fell below its 2018 levels. IXUS invests in companies across both developed and emerging markets. The top 3 countries represented in the fund are Japan at 15%, the UK at 10%, and China at 8%. One of the main benefits of IXUS is that no single country dominates the portfolio, unlike some ETFs that have a heavy concentration in the US or a particular region. This diversification can help protect your portfolio against significant downturns in any one market. Number 3. iShares Cohen & Steers REIT ETF, ticker ICF. Real estate is another asset class that can help diversify your portfolio, especially during times of economic uncertainty or stagflation. Stagflation occurs when economic growth is stagnant or slowing while inflation continues to rise. During these periods, traditional stock investments can struggle, but real estate often provides steady returns. The iShares Cohen & Steers REIT ETF, ticker symbol ICF, is a great way to gain exposure to real estate investment trusts, REITs, which own and operate various properties like apartments, malls, hotels, and warehouses. ICF is one of the oldest real estate ETFs, with over 20 years of history. It tracks the Cohen & Steers Realty Majors Index, which focuses on the largest and most liquid U.S. REITs. These companies own portfolios of real estate that generate rental income, which is then passed on to shareholders in the form of dividends. ICF has the highest expense ratio of the ETFs in this video, at 0.33%. However, given its focus on a more niche sector like real estate, this is still considered a reasonable fee. Over the last 5 years, ICF has delivered an annual return of 6%, which is lower than IDOT but still a respectable return, especially for those looking for steady income and lower volatility. The fund has a size of over $2 billion, which, while smaller than the other ETFs mentioned, is still large enough to ensure liquidity. Liquidity is important because it means you can enter and exit the ETF without much difficulty, even in times of market stress. ICF invests in only 30 companies, making it much more concentrated than broad market ETFs like IDOT or IXUS. However, these 30 companies are the biggest players in the real estate sector, so you're still getting substantial exposure to high-quality real estate assets. The top 10 holdings account for 60% of the fund, so you are more reliant on these specific companies' performance. The sector breakdown shows that ICF primarily invests in specialized REITs, which account for 44% of the fund. These specialized REITs include assets like movie theaters, casinos, and farmland, properties that don't fit into traditional real estate categories like residential or commercial. The remaining sectors include residential, industrial, and retail REITs. Dividends are paid out quarterly, with a dividend yield of 1.98%. While this is lower than IXUS, it's still a solid yield considering the real estate focus of the ETF. If you're looking to diversify your portfolio with a relatively stable asset class like real estate, ICF is a strong option. Number 4. iShares S&P 500 Value ETF, ticker IVE. Finally, let's talk about value stocks. In recent years, growth stocks, mainly in the tech sector, have been the big winners, with companies like Apple, Amazon, and Tesla driving much of the stock market's gains. However, with rising interest rates and a potential shift in the economic environment, value stocks may be set for a comeback. Value stocks tend to be companies that are undervalued based on fundamentals like book value, earnings, and sales-to-price ratios. The iShares S&P 500 Value ETF, ticker symbol IV, is an excellent way to gain exposure to these types of stocks. IV has an expense ratio of 0.18%, which is higher than IDOT but still very reasonable for a sector-specific ETF. Over the last 5 years, IV has returned 8% annually, underperforming both IDOT and the S&P 500 during this period. However, over the last year, IV has outperformed the broader market by 6%, signaling that value stocks may be making a comeback. With a fund size of $24 billion, IV is the largest ETF focused on S&P 500 value stocks. The fund invests in over 400 companies, with the top 10 holdings making up 18% of the portfolio. Unlike growth ETFs, which are heavily weighted toward technology, IV focuses more on sectors like healthcare, financials, and energy. In fact, healthcare and financials alone make up over 30% of the portfolio, while technology stocks represent just 11%. Dividends are paid out quarterly, with a yield of 2.12%, higher than IDOT but lower than IXUS. If you're looking to add some balance to your portfolio by gaining exposure to value stocks, IV is a well-established option that offers affordable, diversified exposure. So, there you have it. 4 ETFs from BlackRock, each with its own strengths and focus areas. Whether you're looking for broad U.S. market exposure with IDOT, international diversification through IXUS, real estate investments with ICF, or a value stock play with IV, these ETFs offer excellent choices for building a well-rounded portfolio. By understanding the role each one can play, you can create a strategy that fits your financial goals and risk tolerance. Happy investing!